We got a nice rally going on, marching towards the highs of the session right now, up 240 points on the Dow. We just heard from White House Chief Economist Kevin Hassett saying the U.S. economy is as solid as we have seen in a whole long time. Joining me right now, Yale Economics professor Robert Schiller with a look at whether or not he agrees with that. It's good to see you, Robert. It's been a while.
My pleasure.
So, 3% growth, is that in the cards? Could it be better?
It's possible. I first met Kevin Hassett when he wrote a book called Dow 36,000. And I was debating him on TV at that time. Mm-hmm. So, I have a lot of respect for the man. He's smart. But he missed that one. I think he has a predilection toward dramatic forecasts. Okay. So probably it won't be as good as that. It could be, though.
But 3%'s not that
as I say, I respect him. Well, it's compared with recent experience, yeah. It's possible. But we're also entering a period where the demographics are working against us. The baby boomers are retiring. That kind of thing makes it seem a little bit less likely. But the real question is, does Trump add spirit to the market and the economy? I actually wrote a book with George Akerlof called Animal Spirits. Mm-hmm. And we argue that actually that does matter. So, I'm not so, I don't mean to be too negative. He could be right. We could even do better than that.
Wow. How much of that is policy? How much of that is just animal spirits and confidence? I mean, you've got tax reform now that's going to be more meaningful for corporations and for some middle-class individuals. And, you also have this excitement, I suppose, that also matters. Yeah, well,
it's got to be a little of both. But my predilection is to emphasize the excitement side. Mm-hmm. I'm not a big fan of President Trump, but I can see how he excites audiences. That's definitely there. So it's possible that we will have higher economic growth. And that's maybe partly what's driving the markets. I think markets are inherently psychological. People look at each other and say, who's excited? If they think other people are excited, they might be inclined to bid prices up in response to that.
Mm-hmm. But let's also factor in some of the other things going on. I mean, we, not today, but certainly yesterday, saw an increase there in yields on treasuries. And there's some concern out there that as treasuries move higher, it gets more and more expensive to borrow money. You mentioned baby boomers retiring. I mean, you've got some things that are sort of working against us in terms of demographics. Mm-hmm. As all those baby boomers say, okay, I'm retiring and I'm out of here. I'm going to go to a state like Florida where I don't have to worry about whether or not I can deduct my income tax or not. And they leave these other high tax states behind with heavy bills. How does this play out? Keeping in mind, and Robert, you're a big, guru in the real estate sense as well as a real estate economist, and so many Americans have so much money tied up in their home. How do you think about how this goes as we move forward towards higher interest rates?
Well, one thing you have to keep in mind is that real estate is not like the stock market. It is very smooth through time. They talk about momentum in the stock market, but it's just a little bit of momentum. Mm-hmm. The housing market is massively continuous along a momentum path. So if you look since the crisis, we've seen increases before in the 10-year Treasury and in mortgage rates, but they didn't have much effect on home prices. They just keep going up. After 2012, for a while, it was 10% a year. Now it's down more like 5% a year, but it just keeps chugging along.
Well,
that suggests to me that it's not as responsive to mortgage rates as many people think.
Good. I'll leave on that happy note with Robert Schiller saying 3% could be in the cards, and don't worry too much about mortgage rates. Thank you so much, Robert. Great to see you.